The crypto market is known as the place where people make wealth with high levels of profitability. However, if you make the wrong move, the possibility of losing everything is as high as your returns could be. Investing in crypto is always risky. Don't let people lie to you about it. It isn't easy money, but they don't have to be the highest. Actually, you can deal with lower risks if you avoid some of the biggest mistakes while investing. And don't think just because you have been buying, selling, and trading cryptos for a long time that you are free from these mistakes. That's why we made this list. It's complete content getting straight to the point so you don't lose more money. But before we start talking about our list, remember to subscribe and turn on post notifications. Also, you can check our links in description with bonuses to trade, buy, and sell cryptos with lower fees. Now let's begin. Disaster. That's what happens when you start investing in cryptos without a plan. This should be your first step as a beginner, and what really surprises me is the fact that many expert investors and traders just ignore that. Then, when the market crashes, they crash together. So you must have your stop losses in place and a mental framework planned in advance to accomplish your primary objectives. That's why you should consider aspects such as how much you intend to invest, which assets you think are worth buying, for how long you'll be holding those assets, and where you store them. Another important thing is to have an exit strategy. Exit strategies help investors to mitigate extreme losses or market crashes. An exit strategy is always key, even if you are earning money with cryptos. Buying on speculation is the worst mistake many beginners make, and this could often lead investors to buy high and sell low. Many beginners focus only on making profits without thinking about the future prospects of that coin or what factors are actually driving the coin's price higher. Early this year, speculation about the mass adoption made both retail and institutional investors buy various coins at a higher price. Those investors lost too much money following the surprise collapse in crypto markets between April and July of this year. Before you invest in cryptocurrency, make sure you do your own research about the project and company behind it. Many cryptocurrencies will rise and many more will disappear with time. So understanding the ecosystem involving the coin you intend to invest in is extremely important. Following the previous mistake, let's see another quite common among investors. One of the top mistakes investors make is not taking profits. And actually, I can understand it. Sometimes we get so excited seeing our investment grow that we think our assets will never drop again. So we decide not to sell it, seeking a better appreciation. Well, wrong. It's not always like that, and enthusiasm can lead you to this mistake. All the crypto market is vulnerable to volatility. When the prices are really high, you can consider selling some of your assets. For example, it's a good option to take out even more than the initial investment if you've reached your financial goal. You don't need to sell everything at the same time. It isn't smart either. But making profit should be part of your investment strategy too. Remember that the market doesn't go up forever. Knowing about the appropriate time of selling is the best approach for capitalizing on gains or squeezing losses. Investing involves winning and losing. However, one can mitigate losses by smartly allocating investments along their level of tolerance to risk. In other words, don't invest what you don't expect to lose. Buying cryptocurrencies by pulling out your other investments could be an extremely unwise move. Instead, you must allocate a very small percentage of your portfolio to speculative assets. I know you hear a lot of stories of people who turned $100 into over $100,000. But you must know that on the other hand, there are thousands of people that lost a lot of money putting their last dime into the market. Only invest what you can afford to lose, because sometimes you will. If you really want to make money with cryptos instead of losing it, it's wise to consider spreading investments across multiple diversification strategies. Investing big on one coin could ruin your wealth and future investing plans. Portfolio diversification is widely held as timeless strategy to decrease the risk of major loss. The digital coin market market has the potential to make or wipe out hundreds of billions of dollars in a few hours alone. The latest price crash in the second quarter of this year is a good example of its volatility. However, some gains can offset the losses. For example, during the last week of August, Bitcoin and Ethereum didn't do so well, but Solana and Cardano performed with prices we've never seen before, with ADA hitting $3 and SOL reaching an incredible $217. If your portfolio had all of these coins, what you couldn't get with BTC or ETH, you can profit with ADA and SOL. Then don't put all your eggs in one basket. Low prices not always represent bargains. Sometimes prices are low for a reason. Watch out for cryptocurrencies with falling user rates. Thousands of meme-inspired coins have been circulating in retail markets, and most of them have no acceptability or utility value. Some investors can buy them merely with the expectation that one day it will turn into $1 million bet. That's why they invest in meme coins like Dogecoin and Shiba Inu. To be clear, a low price does not mean the coin is trading at discount. Indeed, it reflects its demand and actual worth. In Dogecoin's case, Elon Musk's backing played a key role in strengthening its demand. But Elon Musk won't always be here to save the day. There are hundreds of other coins that are trading at a very low price, but eventually they might disappear because of low demand and volume transactions, resulting in losses for investors who try to become early adopters. When you're investing in cryptocurrency, one of the most important things to keep in mind is security. Use a proper wallet, like a Trezor, Ledger, MetaMask, and others. However, if you're going to be holding crypto for the long run, then I highly encourage you to store it offline and away from the exchanges. Of course, you can find a reputable exchange with a solid track record. However, you can never fully guarantee the security of your funds on an exchange. The exchange or your account could get hacked. There are also some examples that hold back user funds and ask them to complete onerous KYC, a mandatory verification of customers' identity, typically by a financial institution. All of that can be avoided if you take your crypto offline. But if you still prefer to store your funds in exchanges, what I emphasize I do not recommend, here's some security tips. Use a strong password for each site and use a different one than you use for other applications. Use two-factor authentication for all your crypto apps. If you have the apps on your phone, make sure your phone has security measures, like a phone password, Face ID, and beyond. Don't check your portfolio or sign into an exchange on an insecure or public network. Okay, getting to the end of this video, but I have a warning for you. We aren't investment advisors. Those mistakes happened with us too. Actually, they are pretty common between investors, especially beginners. Everything we said here is based on our experience. If you wish a deeper analysis, seek professional advice. This video is for informational purposes only. And talking about information, if you want to keep up to date about the crypto market, you should subscribe to our channel. If you enjoyed this content, please hit the like button to help us. And check our links in the description to help yourself too. That's all for today, and I see you in the next video.